you pushed back a phone call so you could do this presentation. And I paged through this earlier, and it's got great stuff in it. So Kevin, take it away.
Thanks, Marty. I appreciate your including me too. And I just have a couple points to make. And then obviously, if anybody has any follow-up questions, they can feel free to reach out. I'm a partner in the investment management group at Stewart & Kissel. As Marty said, we have a large fund formation practice, and I focus on representing private equity and hedge funds and their managers and investors investing in those funds. I'm going to cover a couple of the market trends that we've been seeing over the past few months since the pandemic hit. And certainly, again, if there's anything anybody wants to follow up on, don't hesitate to reach out. So, the first trend that's been really significant is a growth in opportunistic investment structures. So clearly, particularly earlier on in the pandemic, we've been kept busy in part by some of our clients who are, in challenging circumstances. So they're facing margin calls or have liquidity and valuation issues. But there have been a significant subset of private fund managers who are, both new and established, who are taking advantage for any number of reasons of recent market events and forming new funds and raising capital at a pretty impressive rate. I would say in terms of the strategies that we're seeing most, certainly, stressed and distressed asset-focused funds, as a few people have alluded to before, have been extremely popular. Certainly distressed credit, but also distressed real estate and other types of distressed assets. Another strategy is sort of what I would call a recovery fund, a fund merely looking to take advantage of steep discounts that have presented themselves over the past few months and ride them out, sort of ride the wave of recovery. These have been focused on a number of different asset classes: equities, asset-backed securities, leveraged loans. We've also seen them focused on specific sectors, transportation-focused funds, consumer-focused funds, et cetera. And then the third, and Marty, you actually mentioned this at the top of the presentation, we've seen an increase in interest in litigation funding funds. So these, of course, are typically structured like private equity style funds, and they fund particular litigations. With an increase in defaults and breaches of contract, you can expect to see an uptick in commercial litigation, and I think some managers and investors are trying to capitalize on that. And then the fourth, and this is a rather idiosyncratic strategy, but it relates to the term asset-backed securities loan facility that the Fed put out as part of the CARES Act. And so and this is a remake of a 2009 program that was structured in a very similar manner. In late March, the Fed announced that in order to increase liquidity in the asset-backed securities market, they were going to make borrowing available to any U.S. borrower as long as the funds were securitized by newly issued asset-backed securities. And as I said, it's intended to support the flow of credit to consumers and small businesses by facilitating the issuance of ABS. So the way it works is the Fed makes available this cheap financing. It's non-recourse financing, and it's secured by these newly issued ABS. Initially, there was some doubt as to whether investment funds were going to be eligible borrowers under the program, but thankfully this has recently been cleared up in the last week or two. The borrower needs to be a U.S. entity, so fund managers who are setting up funds need to set up a U.S. vehicle to actually be the borrower. And we're aware of dozens of managers who are currently raising funds that are going to focus exclusively on this strategy, so borrow money under the program, buy the ABS, hold them, and collect the yield. There are some other funds that maybe have a varied credit strategy, ABS being a part of it, and they may dedicate a portion of their existing funds to TALF. But the significant majority of the activity we've seen in this area has been for sort of TALF dedicated funds. Usually these funds are structured like private equity funds, where investors commit capital, it's drawn down by the GP, and then distributions are made to investors through a waterfall towards the end of the fund's term. There are some unique tax issues for investors, U.S. investors investing in these funds, particularly for U.S. high net worth individuals and U.S. tax exempt investors. For U.S. tax exempt investors, these are debt finance securities, the ABS, and so they're subject to UBTI, unrelated business taxable income. And for U.S. taxable investors, there is limitations on their ability to deduct expenses of the fund, as well as state tax limitations on the ability of them to deduct the interest expenses of the funds. So we've come up with some unique structuring ideas to mitigate these impacts, including having these U.S. investors who wouldn't normally do this invest in these funds through offshore corporations, which is not something you'd normally see in a private equity or hedge fund structure, but it may have some benefits here given the sort of unique nature of the program. And then,
do they all have to be fund structures, or can they just be special purpose vehicles, or any thoughts?
So it's interesting that you said that, right? So the requirement is that the borrower be a U.S. person, and for investment funds, that means the fund needs to be created in the U.S. So typically they're Delaware entities, and the manager to the fund needs to have its principal office and place of business in the U.S. and have significant operations in the U.S. And so, particularly existing funds that have already been established without the TALF program in mind, the investing entity is often a Cayman Islands vehicle. And under the program would permit you to simply establish a Delaware or other U.S. vehicle right beneath the Cayman vehicle and have that Delaware vehicle be the borrower under the program, notwithstanding that it's owned by non-U.S. investors. And so, as I said, we've seen a tremendous amount of interest in this area from both our manager clients as well as our institutional investor clients. In fact, as continues to release more guidance on the program in the next couple of months, that these funds will raise a significant amount of assets. So the third trend, and this is the last one on my list for now, is clearly the fundraising process for private fund managers and for institutional and family office investors has been turned upside down. There is commonly a fairly significant in-person component to the due diligence process for large allocators. And so the result of that, there's a few different results. One is, certainly managers who have existing LP relationships and managers with brand names and managers with significant LP followings are clearly at an advantage over emerging managers, because there's a sense that there isn't as much of there shouldn't be as much diligence required on a kind of brand name manager there would be for an emerging manager, and so investors are more comfortable allocating capital to them. Allocators are still really focused, notwithstanding the fact that they can't do the in-person diligence on operational areas. And we've seen a number of different, somewhat creative solutions to this issue. I think that when this crisis started, that there was a certain sense that this was going to be a temporary problem, and so diligence was put on hold for a lot of our clients. But as the weeks have wore on, and I think there's a growing sense that this is not, all that temporary an issue. We could be in the same situation certainly through the summer and perhaps through the end of the year, that rather than just putting their processes on pause, allocators and managers are trying to come up with alternative solutions, and alternative methods to satisfy their due diligence requirements. So in April, we conducted a survey, an operational due diligence survey of a number of allocators in the market to kind of see what they were doing and were, thinking about doing as it became clear to people that this crisis was going to stretch on. And so here's some of the key takeaways. So one, we found, the sales cycle, the time between the first contact between an investor and the time to the closing is clearly lengthening. I mean, it's only been a few months, but I think that's probably fairly obvious. The impact of the crisis on fundraising for emerging managers, as I alluded to before, too early to tell, but established managers certainly would seem to be at a significant advantage, or at least, emerging managers who have strong backgrounds and strong existing relationships, maybe through prior firms, will also likely be okay. Fee discounts in hedge funds, that's been a huge trend we've seen. Where funds have had drawdowns in March and April, we've seen a lot of these funds offer existing investors the right to make an additional investment in the fund with an assumed high watermark. In other words, sort of like a built-in one-time hurdle rate, as a sort of show of good faith on the manager's part. If they put more capital in, they're going to pay less fees. Video conferencing during the diligence process is obviously pervasive, as it is with sort of all of our lives right now. We've even seen some managers, to replicate the on-site due diligence process, make videos of walkthroughs of their offices and send them to prospective investors, just to sort of allow them to tick a box. And then the other thing is, of course, the diligence process is historically contained. A portion of it has been on-site due diligence, in-person interviews, et cetera, and then a portion of it has been document requests, follow-up requests, questions, et cetera. Whereas information might have been learned in an interview with a CCO or a CFO in the past, now it's increasingly being learned through increased document requests and the use of intralinks and other services that allow managers to post documents on a temporary basis and prevent prospective investors from downloading them, et cetera. So people are rethinking the approach overall, as I said, particularly as it seems like we're going to be in this situation for quite a while.
Hey, Kevin, a couple of quick questions.
Of course, Marty, go ahead. Yep.
So, we had seen a lot of co-investment in the private equity and venture capital space. Do you see that increasing or decreasing as a result of the pandemic? Or, I've seen incredibly outsized co-investment amounts in Silicon Valley in particular.
Yeah, I have. We're working on a number of sort of dedicated co-investment vehicles right now. Now, I think I would categorize those into one are, they're not truly co-investment vehicles, but they're, funds that are established to make a single investment. And we're seeing a lot of that because managers will find a particular opportunity that has arisen in the last few months that, was unexpected, and they want to take advantage of it and are comfortable with the concentration of a single investment fund. And the other bucket would be a true co-investment vehicle where there's excess capacity in a private equity fund. And we've seen some uptick in that activity, I think, and I'm just speculating as to the reason, but perhaps, private equity managers are being a bit more cautious in deploying their capital and would prefer to take sort of smaller bite sizes and then allow co-investors to invest directly in capacity that would have otherwise under normal circumstances gone to the fund.
And you kind of talk about this in this slide that you're showing right now, but you're saying the sales cycle is one thing. I guess that the sales cycle for non-branded funds or new funds, let's say, might be a little bit longer since, how do you do due diligence even if you have all these other tools available?
I think that's probably right. That's the built-in advantage for a big name manager that, there's, institutional family office investors perhaps don't feel like they need to do as much and spend as much time doing diligence. But I will say that, even for brand name managers, the diligence process takes long because, less can be done in person. And so, as I said earlier, I think there's an increased reliance on document requests, which just take longer to get through than having an hour meeting in a conference room with the CCO.
Great, Kevin. Is there another slide?
Nope, that's it. So that's the presentation. So those are the three big takeaways.
Hopefully, when this all clears up, we'll be seeing you in New York City. So I want to thank everybody who attended and all the presenters. I just want to get back to saying that on June 11th, we're going to have Ken Fryer, who's the ex-chief investment officer of Stanford University endowment, who'll be speaking. And then we have Casey Bard, who used to run a hedge fund. Now he runs the family office. He's launching a litigation finance fund. And then Roger Coleman also will be speaking, who runs Coleman Group Partners, and that's a family office as well. So thanks so much, and hopefully we'll see you soon. Thanks a lot, guys.